Look at this chart. Gold isn't just climbing, it's launching. Not in a calm, orderly, markets do what markets do kind of climb. More like someone downed a questionable energy drink, hit play on a David Goggins podcast at 3 a.m. and decided sleep was optional. Because here's the baseline. For 4 decades, gold returned roughly 6 to 7% a year. Nothing flashy. Respectable, slow, predictable, but over the last 5 years, that average is closer to 20% annually. That is not normal. That does not happen in a world that's functioning properly, which means one of two things is true. Either we are not living in a normal, functioning world, or I have severely underestimated humanity's emotional attachment to shiny rocks. Either way, gold is likely printing another all-time high as this is being recorded. And unfortunately, that's just the beginning of the weird part. Because no one can agree on why this is happening. Not traders, not economists, not analysts, not even that one Reddit guy who spends 8 hours a day explaining why the future is gold bars and canned food. Everyone has a theory. No one has an answer. Before we go further, this is actually the perfect moment to say this video is sponsored by Notion. And not in the "they paid me, so now I awkwardly derail the video" sense. This video was genuinely built inside Notion. Normally, researching something like this means juggling macro reports, spreadsheets, and enough open tabs to make my laptop sound like it's preparing for orbital launch. That's where Notion Agent changes the game. Instead of doing everything manually, I can offload the heavy lifting. Here, I asked the Notion Agent for a 2026 outlook on the gold industry, plus a table showing total gold held by major central banks. One click, it handles the rest. And if I want to add more layers, like gold as a percentage of total reserves, I can update it dynamically as I go. So instead of stitching together research from 5 different sources, everything lives in one clean, structured workspace. It's streamlined my entire workflow. Tasks that used to eat up an entire day now take minutes. There's a link below if you want to check it out. Now, back to the shiny rock making everyone uneasy, because one thing is undeniable. Something big is happening beneath the surface. An asset class that's supposed to be boring is suddenly putting up Will Chamberlain numbers, and today we're going to figure out what that something actually is. So let's start by eliminating the explanation everyone jumps to first: inflation. Yes, inflation is brutal. Rent went up, groceries went up, fast food prices climbed so high it feels like Ronald McDonald got acquired by private equity. But gold isn't rising because of inflation. At least, not the way most people think. If gold was simply reacting to inflation, it would have gone parabolic back in 2021 when CPI was doing its best memecoin after an Elon tweet impression. It didn't. It barely moved. The real momentum only started recently, so inflation is part of the story, but it's not the answer, which means something else is happening, and it's a lot more uncomfortable. Foreign countries are quietly losing confidence in the US dollar, and when I say quietly, I mean the same way someone silently deletes all their couple photos before announcing a breakup. The warning signs were always there. People just chose not to look. For roughly 80 years, the US dollar has been the global reserve currency. Central banks stockpile it to settle trade and reduce currency risk. But that behavior is changing. Not dramatically, not recklessly, because dumping the dollar outright would be obvious and likely trigger global chaos. Instead, central banks are doing something far more subtle. They call it diversifying away from the dollar, not exiting, repositioning, slowly, strategically, like trying to leave a room without waking a sleeping dragon. 2 decades ago, over 70% of global foreign exchange reserves were held in US dollars. Today, that figure is around 58%. A 12-point drop doesn't sound massive. Until you remember, we're talking about central banks. That's trillions of dollars. It's essentially the world saying, we still trust you, but we're exploring alternatives. And those alternatives aren't the euro, they aren't the yen, they aren't the pound, they're buying gold. Gold is the side option, the monetary prenup, the contingency plan. And central banks are accumulating it at a record pace. For the 3rd year in a row, purchases exceeded 1,000 tons annually, more than double the prior decade's average. In fact, 2024 marked the highest central bank gold buying year on record, and this demand isn't fading. Over 40% of central banks say they plan to buy even more over the next decade. 95% expect global gold holdings to rise over the next year. This isn't a trend, it's institutional anxiety. It's concern about US debt, long-term inflation, over-dependence on a single financial system. Gold becomes the asset you move into when trust erodes, but you're not ready to start a fight. To be clear, the dollar isn't collapsing tomorrow. Despite what social media says, usually courtesy of someone hoarding silver in their childhood bedroom. The dollar is still deeply embedded in the global system, but we are watching a shift from blind faith to conditional trust. And that matters, because gold doesn't rally when confidence is high. When trust is strong, gold is boring. When markets feel stable, gold stagnates. When institutions feel safe, gold is ignored. Gold only wakes up when stability starts to crack. That's why this move matters. This isn't panic buying, it's preemptive positioning. Central banks aren't reacting to a crisis that already happened. They're hedging against a future they don't fully believe in. And here's where it gets strange. Stocks are near all-time highs. Risk assets are celebrating. AI stocks are priced like they have already replaced half the workforce. At the same time, gold is also at all-time highs. That's not normal. Historically, markets choose a direction. Either risk-on assets surge because confidence is high, or risk-off assets rally because fear is rising, not both. Right now, stocks are pricing in optimism. Gold is pricing in trouble. Bonds are pricing in confusion. Every asset class is sending a different signal. That's how two people can look at the same data and reach opposite conclusions. More mixed signals than someone who says they don't want anything serious and then asks about your love language. So drop your take in the comments. That's usually where things get interesting, because one thing is certain. Markets don't behave like this when the future is clear, and that's why this gold move matters. Not because it's shiny, not because it's hitting new highs every week, but because of who is buying it and why. The most powerful institutions in global finance are quietly repositioning, and almost no one is paying attention. With that said, thanks for watching, and until next time.